I want to make sure everybody's clear on exam one. There's every class, there's always someone that completely misses the boat. Maybe people that aren't here, maybe that's the problem, but so you got a crazy professor who actually expects you to learn the material in the class and not circling it for multiple choice questions, but actually know it. So I want you to know that this question is so critical that you should be able to just sit down off the top of your head and do this entire question. But on the exam day, which I don't know when it is, it's quite a ways off still, but at 2:30, you've got to submit on Canvas your question one answer. So I want to show you what that looks like. Some students think, oh, that's a couple of paragraphs, I'll have it down. It's like, no, I find substance is really important. It's not because I'm detail oriented. It's because details is what gets you the jobs. You've got to know the details. The details are almost more important than anything else in finance. It's those slight little differences that individuals you got to pick up on in order to be able to be successful in finance. So let me give you some example. I was going to show you the best answer I've ever seen on the exam, but I don't want to freak you out because he didn't answer it to get an A on the exam. He answered it to learn the materials. He went out and did a lot of extra research on convexity and duration and put it in his answer. So I don't want to freak you out, but I'll show you some decent answers. I was tempted to show you a really bad answer, but I'm scared somehow that gets back to the person who wrote it. I don't know how that would happen. So here's Mr. Name, and he starts off with definition of the portfolio. Did you see the why, the what, and the how? So he covers those first. Then he gets into the asset classes. So you see how he tied this next section back to that second question. So you'll see how the second question on what can you invest in, that's all the stuff we're doing with asset classes. The DC cuts I, the bucks, it's a big part of the question. Does the four major asset classes, and then he distinguishes between bonds and cash. Then he gets in each asset class, duration, convexity, credit, goes through each one, tax structure, he does all of that. Then he has a lot of students completely miss, you got to set up stocks. You got to talk about stocks. What do we mean by stocks? A dividend yield plus earnings yield. That's really important you understand on stocks, just basically what they are. The strong tie to the economy. Then he does bucks. Out of order, bucks is B-U-C-S, but it makes more sense to do B-C-S-U, but it doesn't spell anything that way, but makes more sense to do the U.S. and then go to non-U.S. Then does alternatives. So students ask me how many pages long should it be, and it should be the right number of pages. Don't ever ask your boss that. Hey boss, I really don't work. I don't want to have to work any harder than I have to. So what's the minimum number of pages I should do? You never tell your boss you don't want to do hard work. So there's one. Does that look familiar? Is he doing crazy stuff we didn't cover in class? Here's another one. You don't have to use the two columns, but they did. Definition of portfolio, the three questions, why, what, and how. Talk about the parsimonious. The three questions under the how, he has that in there. Got into the major asset classes. Price risk, reinvestment risk. Then gets in the bonds, DC cuts I, goes through each one of those. Remember, each one of them, you give a definition, subcategories, and then the strategy. Very important that you do the strategy on each one of these. Then stocks, intro to stocks, and then bucks. And then alternatives, including a short introduction to alternatives. We'll talk about that here pretty soon. And then goes through the alternatives. Now, they have a conclusion. You don't need a conclusion, but they decided, I don't even know what the conclusions. Oh, that makes sense. These are looking really familiar, aren't they? Oh, that's not it. You say, whoa, I didn't study that part. And then again, the why, what, how, exact same thing. So what do you have to do to be successful? You got to put it into your own words. So you just need to go through that, read the notes, listen to the lecture, and then off the top of your head, write that whole thing down. My goal is you just know this stuff. It's just, I mean, if you don't know this, then why are you a finance major? This is what we do. So just know this stuff. How do you get, so you get to know it? The best thing you can do, well, I'm going to talk investment side. There's been studies that the best way to go to class is to take handwritten notes. I know y'all hate that because y'all can't write anymore, right? You're all typers, which is great, but the brain remembers more if you handwrite. But then to actually talk about it. MIT has this wonderful program where classes, they have to go in groups every week and talk about what they did in class. And they just have these conversations back and forth. We should do that at UTSA. But just sit down and go through this whole thing off the top of your head, talking to people, explaining it to them. That's the kind of knowledge, I call it conversational knowledge, that you can just top of your head, just start talking about it. So any questions on that? You see what you need to do? How
much time will we have to write all this?
Well, this is open book before the exam, so you can start right now. You're submitting a Word document. They didn't type that in class. They submitted it at 2:30. Right? Now the second question, you have 30 minutes exactly. You can't go over on that. We're going to practice that here quite a bit.
But
maybe this week, but maybe not.
So that entire document is due on Thursday?
No, it's due on the exam day at 2:30. Right. Yeah. Look on the syllabus. When is the exam? Yes, like still 2 or 3 weeks away. Your paper 1 is due next week, so you're going to do that first. But yeah, it's coming up. But there's no reason. I would already been writing it as we go, so that it's fresh in your mind. You get it out of the way, and you can then do it off the top of your head. So what students are going to fail? Well, guess what? The ones that do copy and paste, they're going to fail it. I will not give you any credit for my words. All right. I'm not saying my words are great or horrible, but I don't need to grade me. I've already got my degree. So I'm good. I'm set. So you got to put it in your words and prove that you know it. I know the definition portfolio is the hardest one to come. Don't go crazy with thesaurus trying to figure new words out. But most of this you can put in very, very different words and make it sound like you know what you're talking about.
So what does an A look like? Just
those were like D- paper. No, those were A papers.
so basically,
But an F is too much copying and pasting. An F is people leave entire sections out. No introduction to equities. Duration. Duration is a measure of interest rate risk. Well, what are the subcategories? Short-term, intermediate, long-term, strategy, interest rate. You got to put all those things in there.
so having it all in your own words, showing that you understand what you're doing, that's basically what you're doing.
Yeah, so that's why you should probably sit down with a classmate and go through your answers and say, wait, you talked about that. I didn't talk about that. So what is too much? There's no such thing. Who in finance knows too much? I don't know anybody in finance knows too much. So what's too little? Yeah, there's a lot of too little.
Where can I find the question? That's exactly how it is.
The question is, someone comes to you with $500,000. What do you do? Oh, well, I need to prepare a portfolio for you. The portfolio is this. These are questions I got to ask you. That's what you're doing. That's the question.
So Barry, like actually want us to like distinguish like how much money we put in each one, or just like it's
No. You're the process. This is process. Yeah.
I don't know if we're going into the nitty gritty or something like that.
No.
We just got another question, or is there someone where I can read this?
I can paste the question, but it's going to be essentially this. I'll give it to you, but yeah, it's define what an investment portfolio is and the process you go through the putting one together for someone. The why, what, how. It's the why, what, how, and then most of it's the what. It's all those asset classes. Other questions? I'd love everybody to make 100 on the exam. That's easy. I could just give you all the hundreds, but I'll never do that. But I'd rather you actually. So I've had professors that are real proud of how horrible people do on their exams. I'm not that professor. I'd much rather you all ace the exam because you know the material versus me giving you an exam that's just so crazy difficult. No other questions? I got it. And how much of this are you memorizing? None. You just got to know it. All right. All right. So we're going to talk about bucks today on stocks, but I want to talk a little bit about productivity. We talked about AI. Could AI be a productivity changer? So this article in The Economist I thought was interesting. Just a few quotes in here. In 2023, the rise in deep learning, more than 99% of research fields, I don't know what the 1% is, Scientists have easy access to what is essentially a dog superhuman research assistant. So it's like AI is like this person they hired that works 24/7, is faster than anyone else they've ever had before. A little myopic, just looks at everything the same way, but they can go through millions and millions of pieces of data. I mean, think about AI in medicine. You got your doctor and he or she's trying to read the latest AMA journal. You know, you come in with a rash. Oh, wait, I think I read an article seven months ago on that. What's AI doing? Reading every single article ever published, the second it's published, all day long, far better than the doctor can do. Which would you rather consult? I want the AI. I want every single thing that they've ever read about this to come immediately to the doctor. So it's a superhuman research assistant, tirelessly sift through numerous piles of data to look for patterns, search through 200,000 of the known stable, whatever compounds. The AI had previously learned the most important physical and chemical properties required for new battery material to achieve its goal and apply those conditions to the search. It successfully reduced the pool of candidates for science to test in the lab from thousands to just 5. Does that sound like productivity, saving time and money? That's what productivity is. Climate scientists began to employ machine learning to speed up. This company made predictions about weather a week in advance thousands of times faster and cheaper than the current standard. That sounds like productivity without a dip in accuracy. That's pretty good. That's the same thing in medicine. AI reading x-rays, they read them faster and they're more accurate than the actual lab tests. Because why? Because they've seen everything out there. It's kind of like the same thing with autonomous vehicles. Autonomous vehicles is AI. The nice thing about AI on vehicles is if they learn something, every single car in the world suddenly becomes better drivers. It's not, you don't learn it car by car immediately. Everybody learns at the same time. I like this one, counting endangered animals. Automatically classifying 3.2 million images saved 8.4 years in human labor. That's kind of what I was doing in class, where I can dump stuff from the internet in 5 seconds that would have taken me years. Those are the kind of improvements we're seeing. These language models that, it's kind of interesting that we're trying to get AI to actually think for us, not just give AI a question, but AI figures what questions should be asked. Pretty amazing. Using tools like Copilot can help coders write software 55% faster. I mean, y'all have friends that are computer science majors. Software coding is radically changing under AI. Going through mountains of research literature, summarize the important ones much faster than any human could. It is already used by students and younger scientists to find it useful to find papers, decide or define. It can even help to extract structured information from millions of documents just incredibly rapidly. Here's a database. Predictions allow scientists to work out the likely structure of protein in a few seconds, look at that, as opposed to years. While AI is penetrating the domains of science, its full potential is far from realized. Accelerating productivity, there's even the word productivity, of research could be the most economically and socially valuable of all the uses. AI tools manage to boost productivity in research. AI will increasingly allow scientists to better model and understand complex systems. So people say, wow, AI is going to change the world. Some people don't buy that argument. They say, yeah, AI, the internet, those are great, but they're not the productivity change of going from no electricity to electricity, going from no cars to cars, going from no airplanes to airplanes, right? How long did it take to go from New York to California in the 1820s? Pretty long. Now it takes about a few hours. That's pretty good productivity. What would life be like without electricity? What would life be like without air conditioning? That refrigeration. I think there was one study I showed that in the 18th century, 19th century, and before, a typical woman would spend 80% of her day preparing meals. Any of y'all up for that? You want to spend 80% of your day preparing, what is it today? A few seconds, you can drive by. So they're arguing that, yeah, what we're seeing today is important, it's efficient, but nothing like we saw back in the early part of the 20th century. So maybe productivity is dead. There are people say we come to peak productivity. We discovered all the easy stuff, and now it's going to be really tough to get better. Who knows? Those are the arguments they make. But that's critical as a stock investor because productivity is a strong tie to growth, and stocks is all about growth. So let's look at stocks. Yeah, there's rumors about AI in the investment world. There's people doing it, no question. The success, I haven't heard any data that shows how good they are. So a lot of people I shouldn't say this on, but I had a boss that he said, it's just intuition, it's my experience. And we were trying to take over his portfolio, so he was training the guy working for me, and he made it so ambiguous. And about 3 weeks later, the guy working for me goes, hey, I figured it completely out. Every time this number does this, he decides this. It's a real easy algorithm. And AI could have done it in 3 seconds. But why didn't he just tell us that? Because he wanted to make it sound like he was this, brainy guy. A lot of what we say is intuition is just really bad statistics and bad repetition that AI would not only do better and faster, but actually correct our errors. So experience is not as valuable as we think. But can AI do better? The question I have on AI and investing is what happens when everybody's using AI and AI is competing with AI, and who wins that equation? That's going to be funny because AI is trying to figure out human patterns. Now it's going to figure out AI patterns. And that's when I'm in the old folks home, and I don't have to worry about it. That's going to be y'all's problem. All right, for stocks, we're talking about growth, earnings, and we're going to break into 4 categories. Bucks. B is I call beta risk. So beta, you think about beta in the capital asset pricing model, it is a number in that formula, but it's taken on its own definition. Beta essentially means your exposure to the market. So a lot of hedge funds use beta in a very different way. So how much is alpha? How much is beta? So beta, we're just talking exposure to the market. So with this beta risk, you have 2 things here. One is your overall allocation to stocks. Because stocks are very exposed to the economy. So your first beta decision is, do I want to be heavy in stocks or light in stocks? The second question is, within stocks, do I want to be cyclical or defensive? Cyclical is going to be very exposed to the stock market, high beta. Defensive is going to be exposed to the market, but on a kind of muted way, low beta. So that's what you're looking for. We're going to talk about beta as a formula later. So we define the world as cyclical and defensive stocks. Cyclical, very sensitive to the economy. Strong economy, they're going to be great. Weak economy, they're going to sell off. And defensive, those are stocks that will probably be off in a downside, but not nearly as much. In fact, Walmart had a positive return in 2008, about the only stock in the entire S&P 500. So Walmart actually benefited in 2008. Most stocks were down, quite dramatically, but cyclical stocks down even more. What's the cyclical stock? High-end retail like Nordstrom's would be a cyclical stock. Durable goods like cars, heavy equipment, planes, those type of things, very expensive things. That's what you cut back on when you're expecting a recession. Commodities tend to be sensitive to the economy. We tend not to drive as much when we're not working. And so gas prices will come down, oil prices come down, steel prices come down. We're not doing as much construction. Travel and leisure, obviously. When's the last time someone's, I'm worried about losing my job, so I think I better go on vacation. That's probably not what they're saying. They're probably saying the exact opposite. We're going to cancel that vacation. And then Nordstrom's is consumer discretionary, travel and leisure, that's consumer discretionary. So those are cyclical stocks. Defensive stocks are those things we tend to spend no matter what the economy is doing. So department stores tends to be defensive. Gas does have a relation to the cyclical. So when people are losing their jobs, they do drive less, but they tend not to drive so much less that gasoline is a highly cyclical. Food, we tend to buy food no matter what the economy is doing. Anything consumer staples, utilities. Telecom used to be, telecom is no longer telecom. So S&P created a whole new sector. They call it communication services, and they moved telecom into that. So telecom used to be a low beta, but it's a very, very different market today. And in healthcare is a little interesting, kind of like gasoline. It has a tie to employment. So a lot of people get their health insurance through their employer. So if they lose their job, they may not have as much, but it's not as exaggerated as these other industries. So we tend to think of it as low beta. And then some are in between. In fact, some people think of an Apple iPhone is becoming almost a requirement for our lives, that we might give up on food before we give up on our iPhone. That the betas on some of these things are coming down just because they're so influential in our daily lives. So tech has generally been considered above 1, especially after the .com crash, but it maybe not as high as it used to be, but it's debatable. You can certainly do statistics on these things. So here's the sectors for the S&P 500. So tech is the largest, but that's a little deceptive, because they moved a bunch of companies from tech to communication services. So Google or Alphabet is in there, Facebook or Meta is in there. I guess anybody who moves also changed their name. But yeah, there's some big companies, communication services, that used to be in tech. So if they were still there, tech would probably be 35% or so. So tech is huge. What's the second biggest one? Or then you get into the consumer stocks. About 20% is consumer, discretionary, and staples. The next biggest, healthcare, is big because it's 16%, 17% of our economy, so it's a big one. Healthcare generally does not include health insurers. You can get a little bit of debate on that. Usually health insurers are under financials, but I think Humana is in healthcare because they do both insurance and healthcare. But financials is a big one. Financials at one point was well over 30%, and then it crashed. Energy was over 30%, and then it crashed. Technology was over 30%, and it crashed in the .com. So now technology looks okay. It's under 30%, but that's because we faked it out by moving Meta and Alphabet. The small sectors, they actually moved real estate out of financials to its own category. I'm not sure why. Now, is real estate 2.6% of the stock market? No, real estate is actually the largest asset class there is. This is only the publicly traded real estate. It's a small segment. None of your houses that you own are in that number because you own it. It's not, you don't trade it on the stock market. So real estate is huge, but as a stock, real estate is really small. And we'll talk about that when we talk about REITs. Energy, look how small energy is now. I mean, that used to be the largest sector by far, huge, and it's pretty small. Materials has always been small. Industrial is much smaller today than it's been in the past, mainly because a lot of that has shipped overseas. And utilities is pretty small. They used to do like utilities and telecom together and those kind of, but they're all there. Now, communication services, what does that actually mean? So it includes AT&T and those type of big telecoms, but they moved Meta and Alphabet into this category because advertising is the biggest part of their revenue. So they're not tech companies, they're media companies, they're advertisers. But that's changing, isn't it? Apple's doing a lot of stuff, Amazon's doing a lot of advertising, becoming a huge part of a lot of these businesses. It's becoming really tough to know where to put a company. One of my first jobs as a security analyst, I was doing the UTSA trust, and my boss said, "Hey, we got this client. Can you restate her portfolio by sector?" And I looked at it and I go, "Okay, where do I put Disney? Where do I put?" It was like I wasn't really sure on some of these, so I just guessed on some of them. Today, I would just look it up on Bloomberg. So it's hard to know where to put these. Have y'all heard of 1-800-Flowers? That company sound familiar? Yeah, they were in technology at one point. That's a retail stock, isn't it? Retail discretionary, but it was under technology. Why? Because you used the 1-800 number. Do you think anyone uses 1-800 numbers to order flowers anymore? You know, you're probably going to do it on the internet. So they're still called 1-800. So, you know, so there's quite a bit of debate which company goes where. Disney's under communication services because it is a media company, but it also is consumer discretionary because it does travel and leisure. Where do you put them? Yeah, that's part of the question. Why do we put them in these categories? Well, it's because we want them in a category where they behave similarly given different economic scenarios. So you don't want a bunch of communication services that are all over the place when the economy is moving. You want them to be somewhat similar. And I'll give you my sense of what a beta should be. So energy is kind of low to medium. Materials is very, very high. Steel, those type of industries are going to be very, very sensitive to the economy. Industrials, almost by definition, are high beta companies. Communication services, the telecoms are still lower beta, not as low as they used to be, but it can be pretty high beta. Discretionary, by definition, is high beta. Staples, by definition, is low beta. Healthcare can be low beta. It can be high beta depending on the particular industry, but generally we think of it as low beta. Financials kind of depends on the crisis. So 2008 was called the financial crisis. So obviously banks sold off a bunch in that environment. It just depends. Banks tend to be a little bit higher beta because they're very sensitive to interest rates, very sensitive to recessions because they have a lot more loan charge-offs. Tech tends to be medium to high. Real estate tends to be high beta. Utilities are almost by definition low beta. If you look at my range, I rarely have a beta below 0.5. That just doesn't make sense to me. If you look at Costco or Walmart, their statistical beta has been below 0.5, but I don't like to go below 0.5 just because it just doesn't make sense to me. And I rarely go above 3. To me, 3 is industrial with a lot of debt. And we'll talk about that later when we talk about beta. But I don't use really, really low betas, really high betas. Are there companies with negative betas? Are there companies that do well when the economy is crashing? And most people say, hey, well, gold. Doesn't gold do well when the economy is crashing? Gold was negative in 08. Gold stocks were negative in 08, so it didn't quite work in 08. Gold was down, and last year we had inflation, so it fell twice. But if you go out and look statistically, you will see gold companies with negative betas. We'll talk later what that means. But generally, a negative beta means you're comfortable with that stock earning less than you could get on a treasury, and you'd be happy with it. So treasury is paying 4.5%, a gold company giving you a 2% return, you'd be happy with it. I don't believe anyone believes that. So I don't use negative betas. I had a group, one of the ladies in my class, she had a team project and she was showing me the team project before they presented it. They were doing a real retail stock and she's doing the valuation. He said, yeah, and the beta was negative 0.7, blah, blah, blah. And I said, wait, what? Which stock has what retail stock has a negative 0.7? He says, well, we looked it up in Yahoo Finance. I said, yeah, that was your first mistake. Yahoo Finance is not where you get betas, right? You in my class from last semester, remember that. Beta is a forecast. It's not a statistical number you look up. So I said, yeah, why are you using negative 0.7 beta? That makes no sense at all. So they changed that and it ended up getting a really good grade on the paper for changing that and discussing it. And I was like, see, yeah, it's an important concept. So we'll talk about that. Beta as a statistics versus beta as a forecast. So what is your tactical moves? Pretty obvious. In fact, this is going to be true on all of these. Strong economy, go high beta. Weak economy, go low beta. Strong economy, over allocate the stocks. Weak economy, under allocate the stocks. But y'all knew that before you even started your class. So that's pretty obvious there. What's the beta of your portfolio? Well, statistically, it's really easy to get. You just get the historical betas of all your companies and weight average them, and that's the beta of your portfolio. But that's history. You're worried about the futures. So you have to do a little more work than that. But yeah, expect a recession, reduce your stock allocation, reduce your beta. How have these different sectors done? This year, tech and communication services, and that is mainly Meta. Meta's up a bunch. Meta is so big that it really drives communication services. So tech, communication services, consumer discretionary is up. I'm not sure which particular sub-industry is driving that. For the last year, tech is the strongest, communication services is the strongest. Last 5 years, tech, by far, twice as high a return as anything else. Last 10 years, tech, by far, 20% return, annual return versus almost twice as much as anything else. Pretty amazing. Why isn't communication services doing better? Well, because Meta, that's when they had their blow up. So when Meta fell, 80% or whatever, 60%, even though it's come back, it hasn't fully come back to help that return. Utilities are down, real estate is down. Why is that? Because they're high dividend yielding stocks. They compete with bonds, interest rates are up, they tend not to do well. So real estate's struggling right now just because interest rates are higher. Utilities, a lot of senior citizens love utilities because they have these wonderful yields, but if you can get a treasury at 5%, why buy utility? Energy's been the worst the last 10 years. Energy last year was the best, but growth stocks have come back so strong this year that they've caught up and passed. So just in 2022, Valero and Exxon were the two highest returning stocks in the S&P, just because oil prices are up so much, and Putin didn't hurt. So Putin probably had put call options on Exxon and Valero because it definitely helped that industry. All right, questions on beta. Pretty important concept. All right, so I'm going to jump to the C, capitalization, which is the size of the companies. We tend to think of companies as large cap and small cap, but also mid cap.
Will we follow the same philosophy we run beta and bonds?
I don't think of bonds as having a beta because bonds are a little tough. So the reason beta works is in good times, stocks are way up and bad times they're down. There is no way up on bonds. You buy a bond with 6% yield, your best case, you can make 6%. Your worst case, you lose 100%. So for beta to work, you have to have skewness on both sides. Yeah, so that's why bond investors are so conservative. They have no upside, they have all this downside. So yes. So I've never seen anyone calculate a beta. You can calculate a beta on real estate. It's a little tougher because you don't have the prices really to do it. All right, capitalization. So the ones we want to focus on are large cap, mid cap, and small cap. There's also micro cap. I tend not to think of micro cap. There you're getting in really, really early. It's a good chance that company will just go out of business. There's a lot of biomed firms that are micro cap. They don't have any revenues, but they got some patent they're hoping is going to work. Would you jump in on that? Yeah, but you could easily lose 100% of your money. I've never bought a stock where the firm had no revenue. I'm just too chicken to do that. But yeah, you could do that. That'd be a microchip. And then a penny stock is what? It's a company that's going out of business. They will go out of business. The stock is worthless, but it's still trading because the short sellers need to get out. So those stocks can move 100% in a day, and they can go to zero. People were trading GM stock well after we knew it was defunct, and just trading. And why would it go up 100%? Because some short seller shorted the stock, and they need to close their position. When they close the position, how do you do that? They buy the shorts back, and that causes the stock price to rise. Can you make money on penny stocks? Yeah, you can make money on penny stocks. You can make money in Vegas. Yeah, it's possible. So we're going to ignore micro and penny stocks and focus in on large, small, and medium. I put numbers in there, 20 billion, 1 to 25. We don't really know. It changes as the market changes. So a large cap over 20 billion, yeah, that's probably a large company, but some people might consider some of those mid cap. So it's hard to know exactly where the break is. It's going to move with the market. If it's less than $1 billion, that means definitely small cap. If it's over 50 billion, that's obviously large cap. When you get in between there, it's all they do. They don't define it by market cap. They define it by this order. So S&P just takes the 500 largest, the 600 smallest, the 400 in the middle. They're just, whatever the market is, they just take that chunk. They tend to all be highly correlated to each other. So this is not a diversification play. This isn't like beta, where cyclical stocks do really well and strong economies are really weak. And it's not that kind of play of diversification, but it does relate to the economy. So large cap, I should have made the notes better here. So make sure you correct this in your notes. Large cap have lower relative expected return versus small and mid cap. All right? Some students miss that on the exam. Large cap have high expected returns and high risk, but relative to small and mid cap, they're lower, all right? Don't imply that stocks have low relative expected returns versus bonds. They don't. They have much higher expected return than bonds. So make sure you know. So we're talking about relative to small cap and mid cap. Large cap have lower expected returns and lower risk. Why is it? Because they're huge. It's hard for them to grow as fast as a small company. Small cap relative to the stocks have the higher expected return, but also higher risk. So what does that mean? If you expect a recession, you probably want to move up in capitalization and buy larger, more stable companies and avoid those small companies. Small companies tend to go out of business in a bad recession. So you see the definition, capitalization, just the size of the firm. That's pretty straightforward. Subcategories, large, medium, and small. And then strategy, pretty straightforward. Strong economy, small cap, weak economy, overallocate to large cap. We'll see when we're doing question 2. There's times where you need to use the phrase within stocks. So if you're expecting a recession, you probably want to reduce stocks overall, but within stocks, you want to overallocate large cap, small cap. So your large cap may be lower than normal, but relative to the small cap, it's larger. So your large cap might normally be 40%, you're going to go to 38%, or your small cap may go from 10% to 0. So within stocks, you're going to probably want to have more large cap. Strong economy, yeah, just small cap is a great place to be. Here's the historical performance, and you can see they're all right on top of each other. You can hardly tell a difference, but that's not always true. Small and mid cap materially outperform large cap out of the 2008 crisis. But since the pandemic, they've all essentially moved right together. And you can see how much riskier small cap is, because look at small cap and mid cap, they dropped a whole lot more in large cap. But generally, they move very much together. When they sell off more. You notice they come back together on the downsides, because small cap sells a whole lot more than large cap. I should have done a log normal chart, because 2008 doesn't look all that big. But if log normal, it would be a pretty big drop. So here's the actual returns. Mid cap has actually been the highest returner, but they're all right on top of each other. Hardly can tell the difference. My favorite asset class is small cap value. We're going to talk about value versus growth. You can't see that in here, but I'm a big fan of small cap value. But here recently, it's been those large cap growth companies that have been dominating, and that's what caught them back up after COVID. All right, questions on capitalization? What's the largest company you can think of? Apple or the Saudi oil company? We don't really know how big that is, but we can kind of guess. Bigger company, incredible earnings. I don't know if you've looked at Saudi oil company's earnings. It's just dwarfs everything else in its path. So Apple, Microsoft, Tesla was up there and then it dropped off. Meta was up there and it dropped off. It's coming back, but very, very dominating. I mean, it's pretty. I did a presentation this last summer. You take those top growth tech companies, and we've never seen that few companies dominating the stock market like that. It's just incredible. I was looking at Apple. Apple's market cap is larger than the entire US stock market was when I graduated from college. Apple by itself. Now I know you have inflation and all that kind of stuff, but Apple by itself was the entire stock market. Bigger than the entire stock market when I graduated from college. That's how big Apple is today. Medium cap is hard to distinguish from small cap. It tends to move very much like it. It's been interesting the last few years. Medium cap, mid cap has kind of had its own little life. But I think it's not so much that they're small and mid cap. I think there's certain industries that dominate mid cap and certain industries that dominate small cap. So I think it's more of the beta play than it is the small mid cap. Historically, over the long term, small cap has been the highest returning. But because of what's going on with these high tech companies, those are big companies that dominated the market. I wish I had 2000 in there, and 2000 is really interesting because it looked like a major stock sell-off, but small cap actually did pretty well. It kind of just went through with hardly any losses because they weren't the ones selling off. They were doing pretty well. So you can have periods of time where one will really dominate the other, but they tend to move together, so there's no diversification, but the relative returns can be quite dramatically different. All right, then the S on style. There are a lot of people in our industry that do not believe in style. They just don't think it's a good classification, but you got to learn it because it is definitely out there. So we have growth and we have value. What is a growth stock? A growth stock, you can think of, if you're a growth investor, a growth stock is a firm with high growth. If you're an anti-growth investor, growth stocks are expensive stocks, overpriced stocks. So it depends. So growth stocks are high expensive because they're expected to grow really fast. Value stocks are expected to grow really slowly and they're cheap because of that. Now be very, very, very careful here because you might be surprised on the strategy here. Put this in your notes. Value is not the same as quality. Value stocks are low quality companies, all right? Get that in your notes. Value stocks are low quality, not high quality. Why are they so cheap? Because they have some serious problems. Their earnings may be negative, they may have too much debt, they're really struggling. So JCPenney is a value company. Does that sound like a high quality company to you? Absolutely not. Bed Bath and Beyond, that's a value stock. They're still trading. Does that sound like a high quality company to you? So growth stocks are high quality, value stocks are low quality. So value stocks have low expected earnings growth, and so they're cheap. Growth stocks have high expected growth. So which would you want? And this is where it's surprising. I have to show you the GMO article that I was showing you. So I'm going to give you the tradition, which is the exact opposite of what GMO is saying right now. But you'll notice in the article, they're acknowledging what I'm telling you, and they're saying this time it doesn't work. So the traditional approach is growth stocks do better in weak economies, value stocks do better in strong economies. Why? Because value stocks are low quality. They can get clobbered in a recession. So don't equate value with quality. Growth stocks actually do better in weak economies because their prospects are a lot better. You might think that doesn't make sense that they're expensive stocks. You think they'd sell off more, but they tend to have much more solid earnings, more profitable. They don't have as much debt, much more stable. They tend to do better in weak economies. The last few years, that hasn't been true. Growth stocks have just done well, and value stocks have kind of just meandered around. I did grossly allocate value stocks last year, beginning of 2022. That was great. I thought it was a genius. And then this year, growth came roaring back. So, you know, it's been a growth cycle here. Over the long term, value has been the place to be. There's a guy who actually wrote a book about it, Hagen. He unfortunately passed away unexpectedly when real young, but he wrote this book, The New Finance. And his whole purpose for this book was to say value is the place you want to be. And he wrote it at the worst possible time, right before growth really took off. But that was his argument. Now, I don't like arguments that say value is the place to be because it's done so well. That's to me not a good argument. But what he was arguing in the book is value is the place to be because it will continue to do well. And his argument was there's a bias in the market to analysts and where they buy stocks that causes growth stocks that underperform and value that outperform. He discussed that, how the investment management world is compensated and set up. So he at least had an argument for why he believed it would continue. So that's good. So I don't know if I recommend this book because it's kind of old now, but he does make the argument for value stocks. And, you know, if he'd done that last 3 years, you'd probably be pretty disappointed. Let's see if I can get GMO. I don't remember my login, so I don't know if I can get in or not.
Yeah, it's not in there. It's gonna make me log in. So GMO is writing a lot about value versus growth. And a lot of people say, hey, you've got to avoid value because the US might go into a recession. So remember that. You want to avoid value in a recession. They're saying, no, that's not true. And the reason they're saying it's not true is because they think growth stocks are so grossly overvalued that even in a recession, value will outperform. They say growth stocks are not as grossly overvalued as we're in the 2000.com prices, but really close. This is like the second most ever they've been overvalued. That's the first argument. The second thing they say, which is a little more confusing, but let's talk about it. The second thing they say is everybody's expecting rates to fall because we're going to go into recession. Well, historically, growth stocks like interest rates falling, value stocks do better, interest rates rise. Why is that? Because of growth stocks, so much of their value is way, way out into the future. And you know about duration, right? That implies growth stocks have a much higher duration. You remember duration? Growth stocks have a much higher duration than value stocks. So what does that mean when rates rise? Growth stocks get pummeled. What happened in 2022 when interest rates rose? Growth stocks got pummeled. And value stocks did okay. So that's the other argument. They say this time that doesn't count either. Value stocks will do well even if interest rates fall. Why? Because growth stocks are so grossly overvalued. So that's their argument. But convention, they're not saying convention's wrong. Value stocks avoiding a recession, value stocks avoiding when interest rates are falling. They're just saying we're at a point where growth stocks are just so overpriced. And I've been buying that argument. It hasn't worked for me the last few months, but it worked really well last year. Growth stocks do look really, really expensive to me. So, you know, you can make your bet wherever you want to make it. But you are somewhat fighting convention right now. If you're expecting a recession and rates to fall, that is the traditional time to avoid value stocks. And GMO is saying this time, buy them. All right. So if you expect a recession and interest rates to fall, growth stocks should be your best bet. If you're expecting a strong economy and interest rates to rise, value stocks should be your best bet. And that's true. We saw that at USA. In fact, I was shocked. We did the analysis, regression, and all that. I was expecting the exact opposite. Growth stocks do well in strong economies, values do in weak. And I go back to my team, like, no, it's the exact opposite. I found exactly what GMO's arguing against. Like, yeah, it's pretty strong. Growth stocks really do well in weak economies versus values. And why is it? Because we think value, we think quality, and you just got to get that out of your mind. All right, questions on style. Style is kind of a tough one for some people. So does anyone actually buy all this stuff? So let's go see. I never know what's going to come up on the internet, so hopefully no articles are. Okay, is it doing anything? There we go. All right, so let's start off with the asset class. What asset classes do they have? They have stocks, that matches. Fixed income, that matches. Money market, what is that? It's cash. Balance, what is that? Balance means you have to have some stocks and some bonds. So you have this combination. What are they missing? Sector and specialties. So that may be where alternatives are. Sectors isn't one of our groups, right? We're not doing sectors as a different asset class. Specialty could be things like commodity funds. They may have something that's kind of alternative in there. They don't have real estate because you can't do real estate in a mutual fund. They might have a real estate investment trust, but that's very, very different. So they have 3 of our 4 asset classes right there. If you do fixed income, what do you start noticing? What's that right there? Intermediate term, that sound familiar? Muni, what is that? That's the T for tax exempt. Long term. There's the international. They do have an international fund. Government, what's that? On credit, right? High quality, intermediate term government. What's there? High yield. Right? So they're following that exactly. What about stocks? large cap. They say blend. Don't use the word blend. Y'all remember the word when you have. Well, why do they say blend? First of all, they say it's balance between growth and value. But don't use the word blend. Anybody remember the word? So we use core. Yeah, that's a core fund. You don't use blend. Just doesn't sound right. Somebody at Vanguard messed up there. But yeah, it's a core fund, but it's large cap. So it has some value, some growth. What about this fund? It's a value fund. When do you buy that fund? Strong economy, rates rising. It's an international value fund. So even more specialized. I don't want bonds anymore. How to get rid of the bonds? Go away. Go. How does it? I don't want that. Why won't it take it away? There we go. Wow. So you got large cap, mid cap, small cap, value, blend, value, core, growth, just like we're talking about. US versus non-US. They've got the entire bucks there with the exception of beta, right? You don't really have beta funds. So that's the one you have to kind of guess on your own. But yeah, everything we're talking about is exactly, there's a mid cap growth. They're taking the C and the S and they're doing mid cap and mid cap growth companies. You can mix and match these things all over the place. There's a small cap growth, a favorite small cap value, small cap, mid cap core, a lot of international funds. They even have a all US fund. All right, so global, we're going to talk about international and global. The difference between global and international, when you see the word global, it includes the US. When you see the word international, it excludes the US. All right, so they have a global fund, which means you can get every stock in the world, at least an approximation of it. This says select global, so it's probably not every stock in the world. So Vanguard's taking this class. They're following it pretty closely. So, fortunately, they know what they're talking about here. So their style. The other thing you can look at, let's try the contra fund. It's always my favorite one to bring up. So here's the contra fund. If I go to profile, what does Morningstar give us here? They call it a what? A style box. That's what we just said, right? Style, B-U-C-S, that's for styles. Let's look at the style box. They got value, core, and growth, large, medium, and small. So what is the contra fund? It's a large cap growth fund. And that's where it shows it right there, large cap growth. What don't they have? They don't tell you if it's international or US, but contra fund's a US fund. So yeah, I mean, they're using the same terms we're using. This has been around for 20, 30 years. It's become somewhat just core to how finance talks about in the investment world. Right. So you should feel comfortable. I'm not making this stuff up. I think my last semester here, when I'm 70, I'm going to do a class where I make everything up and see how long it takes for the class. So this guy's lost his mind, but I'm not doing that yet. So don't worry about it. All right. Questions on style. So yeah, there are managers out there who hate style. So don't give me the style. Don't put me in a style box. They don't like being put in a box. But it's quite popular. You can see it really dominates still in finance. All right. So as far as performance, obviously growth stocks, they really, really sold off in 2022. I was real happy there because I had value stocks in 2022. So in January, it's like, I'm a genius. And they said, no, you're still pretty stupid. But it worked for a year there. But it's amazing. They're almost back to where they were. It's truly remarkable that comeback. A lot of that is the hard landing versus soft landing kind of debate. And again, growth stocks should do better in a hard landing, but because they were so expensive, you can look at history. I should have done this log normal as well. But value stock really outperformed kind of out of the .com, and then they moved right together. But since then, growth stocks have really, really dominated. over the long term, value stocks have really dominated growth stocks, but they go in cycles. At USAA, we discovered historically, back when I was doing this, the cycles tend to be 7-year cycles. Growth outperformed for 7 years, and value and growth. But the last few years, it's just been crazy growth stocks. 10% versus 11% versus 9% at 200 basis points difference in return. That's a pretty significant return. Now, why did I use 200 basis points there? I thought I said don't use basis points when talking about the stock market, but why did I use 200 basis points there? Y'all remember? What are these two numbers? They're percents. So I've said growth did 2% better. That's real confusing. You mean 2% of 894, but 200 basis points pretty obvious, right? 200 basis points, you just add 0.02 to the return. Oh, you can't? Oh, sorry. I don't know how to change that. All right, so it's 8.94%. And 10, about 200 basis points higher. That's pretty significant. 200 basis points over several years, 20 years. That's a significant difference in return. You definitely would notice that. You know, $1 is $8. If you had growth stocks, $1 is $5.50. So, you know, if it's $1 million portfolio, you're talking about a pretty big difference. All right, you ready for you? So US versus non-US. Don't get confused on the exam with the bonds U and the stocks U. They're both US versus non-US, but they're radically different things. Remember, on bonds, few people actually do non-US bonds because of that currency price. Currencies take over. With stocks, the currencies almost helps diversify your stock portfolio. You kind of like having the currency. The currency volatility is about the same as the stock volatility, so currencies kind of hedges you. Unlike the bonds, because bonds are so stable, the currency really takes over. But with stocks, currencies is actually a pretty good thing. So here's our subcategories here. US, that's what we just talked about with beta, capitalization, and style. Then you have developed markets, emerging markets, and frontier markets. So developed market is essentially just like the US market, large cap, small cap, mid cap, style, growth and value. But in developed countries like the UK, Germany, so well-established firms with good institutions, more stable. They have similar returns to the US market, although I'll show you they haven't done well recently. But you do get some diversification because their economies are doing differently, and then currencies really can help you. A good example, I think it was 2021. So Japanese market was down, but if you did it in Japanese yen, it was up because the yen was so weak in 2021. So that's the case where if you've been a Japanese investor, you say, hey, I'm doing great. If you've been a US market investor, you would say, wait, what do you mean you're great? I lost money. Why? Because you're getting converted from yen back to dollars and the yen fell. So currencies can be pretty material to the returns. Emerging countries are these developing markets. There's something going on. There's some problem going on, but they should have higher economic growth, and they're going to have higher risk. There's definitely some diversification benefit, but it's not as much as it's been in the past. Globalization has definitely changed it. China is in that category. There's a lot of countries, the old Soviet Union countries are in that list. A few African countries, a few South American countries, just countries that could do well, but they're just struggling for some reason. And in frontier markets, you're willing to lose it all. These are countries that are in serious trouble. But if they can get it worked out, you'll make 5,000%. If they don't get it worked out, you lose 100%. So a lot of upside, a lot of downside. I don't invest in frontier markets, but there are frontier market mutual funds out there. You want to go wild. Very high risk. Great diversification because it's all about the country. They either make it work or not. Obviously, a global recession could hurt them, but a lot of these countries, they're in such bad shape. They just got to get their act together. And if they do that, they'll do well, even if the economies around the world is struggling. So here's how S&P summarizes the different type of countries. So they have these criteria. The first one is your domestic market capitalization has to be $2.5 billion. Remember, Apple's almost a $3 trillion. We have one company that's 1,000 times that. They're saying your entire stock market has to be $2.5 billion. That's a pretty low standard. That would be a small cap company in the United States. Your turnover has to be $1 billion. How much trading goes on? How much of the stock market is traded? So there's probably been $1 billion in trade just on Apple. So in the US, far above that criteria. The development ratio has to be greater than 5%. This is where China struggles a little bit. So how large is your stock market relative to your economy? Your stock in the US stock market is about the same size as our economy. It's almost 100%. But in some countries, it's really, really small. So you have to have at least, your stock market needs to be at least 5% of your countries. If you meet all of those, and this one extra one here, this is so just to be frontier, you got to get 2 of these. Emerging, you have to have all 3 of this, but you can kick out this $2.5 billion and they raise it to 15 billion. So really, this 2.5 is just to get the frontier markets in there. To be emerging, you really have to have over 15 billion, but that's still a really small number. That's getting kind of mid-cap, one mid-cap stock in the United States. And they're saying the entire stock market has to be 15 billion. And then they have to have 3 of these. So what are we looking at? Settlement T+3. Y'all know what settlement T+3 is? So you buy a stock today and the cash moves in 2 days from now. That's T+3. I did a lot of T+0 trades. The money moves the same second that you do the trades. T+3 is not all that great. The government's debt has to be BB+ or higher. That's a pretty low standard. No hyperinflation. So I don't know where hyperinflation starts exactly, if Turkey is in that list or not. Certainly there's some countries out there that are in the 50 to 100% inflation. So no hyperinflation. No foreign ownership restrictions. I think China struggles a little bit on this. If you can't actually be an investor in the market, you have to be a citizen of that country. That can be a restriction. And then the currency's got to be freely traded. For emerging, you don't have to meet all of these, but they have to meet 3 of these. For developed, you have to meet all of these. And then the last one is per capita has to be at least $15,000. So U.S. capita. So our per capita is $76,000. That's something y'all make 76,000. That's our per capita. Our economy divided by the number of people. I can't remember the largest one. Let's try Luxembourg. I don't even know how to spell Luxembourg. 126,000. I thought when I retired at 70, I might move there. It might be a nice place. It's a really small place. Any of y'all been to Luxembourg? I'm just driving through. Did you actually go to Luxembourg specifically? Is it a nice, pretty area? It must be gorgeous. Yeah. If the poor people are making 80,000. I don't know if you notice it much from Germany, but Chad, $590. That's a poor country, right? I don't know if y'all been reading news about Northern Africa right now with Baco, can remember any firm, but not here. I don't know what's the name of that country, but Burkina Faso, and I mean, it's just a lot of people are having military coups and that kind of thing. That's just horrible for an economy, and obviously the people are suffering because of it. 590. Where we work in Costa Rica, people working with near us, their per capita is about $500. Wow, you really notice it. That's no electricity. That's a tough. And we tend to think about poverty as you're living on $1 a day or $1.25 a day. I don't know if y'all could live on $1 a day. Pretty tough. So I don't know if the poorest country is or the richest, but we're getting pretty close, I think. South Sudan might be obviously going through a major crisis right now. It doesn't, I can't even get it. So, yeah, I mean, there are some places where it's pretty painful. So they need at least 15,000. I don't know where China is right now. I think China's getting above the 11,000. I should look at China. In fact, China might even be higher than that. So so 11,000, 12,000. So they're not quite to that 15,000, but they have other problems that keep them out from a developed market just because of the way their stock market's really restricted. So they're getting up there. I mean, it's when we were kids, if we didn't finish our meal, our parents would say, "What about the starving kids in China?" They don't say that anymore. China is becoming a kind of a good, stable, middle income kind of country. All right, so those are the criteria. So if you go to S&P, in fact, Morgan Stanley, MSCI is no longer Morgan Stanley, they sold it off, but their book, actually, you can go and see which country is listed where. I might do that next class and show you where each country is in these different categories. So it's not a really tough category to be a developed country. Here's how these markets have done. The US has really dominated. Emerging was doing well and has recently come off. And then developed markets have just been a horrible place to be. This is why Jack Bogle tells, before he passed away, he said, "I don't buy non-US stocks. I just buy US stocks. Why waste your time?" You can kind of see it was the right answer. Some people think this might unwind because they see the US stock market looks so expensive versus Europe. But there's good reasons for that too. US is still performing much better than Europe. But yeah, it's been rough. Emerging had been doing well until here recently. So emerging, a lot of people still believe in emerging. It's the developed markets that people are kind of like, why would I waste my time? They just haven't done much in so long. So you can't see the numbers. So the US 9.8%, developed 6.2, emerging 7.4. So the US actually has beat developed markets by 350 basis points these last several years. It was a pretty major outperformance. But it all comes back to productivity. You want to be in the countries that don't have good productivity. You want to be in the countries whose productivity is improving the best. It's the change in productivity. You can see in the US, we've been all over the place, but recently it's come down quite dramatically. So here's one way you can look at it, is the ease of doing business. This is the World Bank, and they stopped doing this ratio, so I can only go back to 2020. They changed it, so pretty soon I won't be able to do this anymore. But New Zealand, I've never been to New Zealand. Looks like a really pretty place to be, but looks like it's also a really easy place to do business. Now, I'll show you the criteria, and I'll show you the criteria. It's pretty important what the categories are. Singapore, I've always wanted to go to Singapore. Hong Kong, maybe not as much now, but Denmark. You see a lot of European, a lot of Asian countries, United States, Georgia, United Kingdom, Norway, Sweden, Lithuania, Malaysia. So these are countries that get the highest doing business score. What that means, if you're starting a new business, how long is it going to take to get all that red tape out of the way? So look at Costa Rica, number 74. I can vouch for that. That is true. It's a horrible place to do business. We have small farmers that just want to sell bananas, and we open a restaurant in the middle of the jungle, and it's amazing what we have to do to open a restaurant, a small restaurant. My friends from Costa Rica, they visited the United States, and I said, "Let me get you a USA bank account so that I can get money to you faster." We drive up to USA at 4:55. They close at 5. We walked out with a bank account and checks, and there was no one there to help us. We did the whole thing on their computer, and we had someone zoom in with us. And they leave, they go, wait, we have a checking account? I said, yes. Well, in Costa Rica, that takes several months, but yeah, that was kind of fun. 5 minutes and we had an account. So what kind of things do you look at? Well, here's their report, detailed report. And they're doing exactly what I would say you want to do. If I can find this first chart. Is they're asking a question, not who's best, but who's improving the most. That's where you want to invest your money. Growth is what you want. Productivity is growth. Who's improving, getting better. So the great companies or great countries are great, but the change is not going to be all that great. So starting a business, dealing with construction permits, getting electricity, that may seem easy, but it's not in some places. Registering property, getting credit, borrowing money, protecting minority investors, paying taxes, trading across borders, enforcing contracts, resolving insolvencies. These are the kind of things they're looking at. And the 10 economies improving the most, and here's the 10 they show. There's some interesting opportunities in there that Bahrain, Pakistan, some of these may not have done well the last 2 years. But that's what you're after, is that improvement. You're not just looking for the greatest that's going to stay up there. You want the firms that are moving up. Now, Putin, a few years ago, he wanted Russia to move up on this list, so they just started doing artificial things, the Jimmy the formulas, and that may be why they stopped doing this report. So there are ways you can fix this report by just the way you report things, and so how reliable is it? So productivity is the key, but not the level, it's the change. How much more productive are you becoming? All right, let's see, where are we on time? Okay, we'll start here. So questions on anything? I'll see you on the exam. Is anyone confused on the exam? Everybody knows what you're doing? All right. Do we have any volunteers that grade your paper next week on Tuesday? Someone? Huh? No, it's just to show the class how I grade. Yeah. So if you want to do it, email me. You can send me your paper. I can look through it to make sure there's nothing major that you might want to change before then. I might leave some things in there just so I can say, yeah, this or that, so you can see. But if anyone has interest in doing that, email me. All right. So I promise you, DC Cuts Eye, if you get an interview question, you've got it covered. That is, I've challenged all my fixed income friends, add something to the list, and they can't think of anything else. So it covers everything. I realize the S is massive, but they don't expect you to know the S in an interview on a graduate. And if you take John Tui's class, he's going to go into this stuff a whole lot more. He's going to spend a lot of time on structured debt because it's really quite extensive. I find this something really interesting. I always get depressed when I look out and see a student looks really bored and thinking, how can you be bored with this? And if they're a finance major, how can you be bored at 22? You're going to be doing this next 50 years of your life. And finance is really stressful. So you better find it interesting, because if it's boring and stressful, that's like the worst life possible. But if it's exciting, at least the stress is going to come, but at least you can, get through it. Talking about stress though today, what's the bond market doing today? What does that look like? You go into an interview today, what do you say about the treasury market? Selling off, rallying, what is it doing?
Hold off, yield grows.
Yeah, yields are up how much? 2 sigma event. That's a pretty big day for treasuries. I think we're at the all-time high for the last whatever many years. So I mean, it's pretty. My next buy point is like 550. 453. So I'm getting close to. I extend my duration. I have this kind of dollar cost average in, so I'll get to extend the duration one more time. We hit that next level. But is that all because of the Fed? Well, the Fed was yesterday. Can it actually take them 24 hours to figure it out? It sounds like it. It's complicated stuff. The stock market's down, not down as much as the bond. Well, it's getting up there. It's a sigma event, more than a sigma event. They use the word slide. I wouldn't use the word crash. 1.5% is not a crash. to me, you gotta be 3, 4, 5% for the word trash. Slight, I guess that tells you something. That kind of implies big, but not crazy. Why? Because he said 3 words, higher for longer. It's amazing, boy, back with, Greenspan didn't believe in transparency, so he always talked in code. And they would debate about one little word he would use. Everybody's debating what did he mean by that, and it was just amazing. Bernanke was more of, we need to make sure the markets know exactly what some people disagree. They think, the Fed should keep some hidden, so they have some tools just in case the market doesn't do what they want. But Bernanke's like, no, full disclosure, let them know exactly what we're doing. So, all right. I'm going to leave it out of screen show just so make sure you can see the bottom here. So we're going to talk later, maybe not today. We'll see how far we get. Probably not today, but next week, definitely, we're going to start getting into that tactical allocation question. So I want to show you what GMO does. They have what they call a 7-year forecast. They've written papers in the past about how accurate this forecast is. I haven't seen that in years, so I don't know how accurate it is. But if you look at it, maybe I will put this in screen show, just make it a little more legible. So this is their real return. I may have shown you this before. So a real return. So this is the returns they expect, and then you add inflation on top of it. All right. So this is the return before inflation. So not expecting large caps necessarily have a negative return. They just think when you subtract inflation, it'll be negative. So US large cap, they expect the underperform, small cap underperform, international, large cap, international, small, emerging. And then they have the only value up there is emerging value. What do they do value on that? I don't know. They're really big on value. So if they broke out the US on value, you would see value doing well and growth doing poorly. So they're arguing that the US is just expensive in Europe, and the rest of the developed world is pretty inexpensive, and that emerging looks cheap. On bonds, they think US bonds, now that yields are so high, they think that's an actually pretty decent place to be. International bonds hedged. So what do I mean by that? You buy non-US bonds and you hedge out the currency exposure. That's like buying US bonds. So I'm not sure why they have a big difference between those two. Emerging debt, they like emerging debt. They have liked emerging debt for quite some time. They like TIPS, inflation-linked bonds. They think they'll outperform inflation, which is kind of interesting because that's what they're built to do. And then cash, they actually think cash is going to beat inflation, which is not its long term. So could you bet on this over the next 7 years? Would you win? Who knows? They've been pretty good in the past, but I don't know how they've been recently. All right. I don't know how many of y'all sign up with GMO, but I love them. They sent some great articles. They sent that to me this morning. All right, so we're talking about US versus non-US. So the real key is, where do you want to be in the world? So we talked last class about ease of doing business. So it's their regulatory framework, their employment laws, their bankruptcy laws. One thing I think is real key is education, their educational system. The US has an advantage in that the best educated people in the world, a lot of them come to the United States anyway. So we kind of luck out. We let their country educate them, and then come here and we get all the benefit. So we don't necessarily get overly harmed by our bad education system because we do have a good immigration policy. But have y'all heard of the PISA scores? I couldn't find a more recent one. But on math, US is really low. On reading, we've come up. I don't know how we do well on science. I never had a good science class my entire time in high school, but maybe I just had a really bad high school. I had decent math. I had really good English teachers. I had actually really good math teachers and English teachers. But science, somehow we do better in science. But you notice who's up there at the top. A lot of countries in Asia. The kind of the Nordic countries are in there. There's been some interesting articles. I think this is key in the US. Y'all should all sign up with Corey DeAngelis. He's a UTSA grad. This is his thing. He's trying to radically change education in the United States. And he's intensely hated by teachers unions and others because he's pretty radical in his ideas. But you can agree with him, not agree with him, but we need reform in education. So the question is, what's the right model? His is on vouchers and letting, especially inner city schools that aren't too strong, let their parents take their kids to a private school with a voucher. You can debate that, but we got to get better on this somehow. And there's interesting books. Is it Sweden or Switzerland that they don't believe in homework? The kids have this wonderful recess time, and yet they're doing better than everybody else. You know, it's interesting models that are out there. We've got to get better at this, but I think education's in real bad shape in the U.S. at the college level and the public school level. But we need to move up, and the differences are pretty extreme. Now, one person wrote an article. They actually did a survey. And what they discovered is if you go to China and you pay the students to do well on an exam, the grades don't change. And then they did it in the US, they paid the students and say, you do well on an exam, we'll pay you, and the students did a lot better. So part of it might be just the peer pressure and the incentives. In China, it's like, we gotta do well, we gotta do well. In the US, it's like, oh, another exam, I don't care. So there may be some overstating the higher countries because just the way the exam's presenting, like if you don't do well on this exam, your life is ruined. In the US, it's like, who cares? So there could be some difference along those lines. In the US, it's also pretty disparate, right? It's some really good schools and some horrible schools. I volunteered at a school for over a decade, an inner city high school. Oh, at the end of it, I was like, these kids would be better off if they dropped out of middle school. It was such a horrible high. I could tell you horrible stories of, I used to listen to the teachers outside the room, and I was like, they started teaching economics, and I was listening to the economics professor. It's like, oh, they'd be better if they didn't teach this because it was really, really bad. And yet there's inner city schools I've worked out that were exceptional. What's the difference? Is it the principal? Is it the teachers? Is it the parents? So we got to figure out what model works, because productivity is directly related to education quality and all those kind of things. So, you know, that's a big deal for us. Now, we talked about on non-U.S. stocks. You had U.S. stocks, developed, emerging, and frontier. There are other ways of doing it. You saw with GMO, they had international large and small. You could do that. So there can be, you don't have to just have developed, you can have developed market large cap, developed market small cap. And there's some people who actually think you should do all of this globally. So forget about US large cap, do global large cap and have that as an asset class. Some other people think it depends on the industry. So if you're doing restaurants, US restaurants is a different group than European restaurants. But if you're doing energy, it doesn't really matter. Exxon, Conoco, Chevron, British Petroleum, it doesn't really matter. Energy is global, it's a global industry. So there's people trying to come up with other ways to do this. What do you want to be? You want to be parsimonious. You want to find a combination, a way of looking at the world that explains a lot of what's going on in the world. So this is one area where people are experimenting, but most are still keeping it developed and emerging. If you go to the Vanguard, it's just going to be developed and emerging. They may have an international large cap, small cap, but it's unlikely. Emerging is an interesting one because in some emerging countries, it's like 3 stocks is 90%. So, you know, are you actually buying that country or just happen to buy those 3 stocks? You know, so it's a little different world. You got to do a lot more research. So how do you combine all these things in a way that you really explain the world? So here's some places you can go. We talked about the ease of doing business. Street Smarts, Jim Rogers. That Street Smarts is a good book. I would recommend it. He's out there on YouTube. He's quite outspoken. There's, you know, when you get to be rich, you don't really care. I met Jack Bogle once, and it was at a conference. You know, he passed away, but Jack Bogle started Vanguard, right? He's kind of like a really important guy in finance. So when he walks in the room, I was like, Jack Bogle's back there, and he's really a big guy. He's very tall. He walks in, and you can, it's like, for some reason, you just know he's there. I don't know, he's not like loud, but he's just like, when he walks in, it's like, everybody's like, who is that? And I don't know, I guess he was loud. I don't know. He walks in with so much confidence. You're like, oh, someone important just walked in. You go, oh, it's Jack Bogle. He sits and listens to the presentation before him. Then he gets up and just tears them to shreds and then talks about what he wants to talk about. Jim Rogers is that kind of guy, really wealthy, just speaks his mind, very controversial, which is what you want. You want people who are going to unsettle you to make you start thinking differently. So he talks about investing around the world. His big thing is Asia. Asia is the place to be. He actually moved to China, had 2 daughters. He wanted them to learn Mandarin, so he had them in China, and then he couldn't handle the pollution where he was living. So he went to Singapore, but his daughters are fluent in Mandarin and in English. That was his thing. So he kind of put his money where his mouth was. I like this book quite a bit. Why Nations Fail. It's essentially asking which countries do well and why. They have a model. It's a really good model. The book's a little tedious because they give you the model, which makes a lot of sense. And then they want to prove it, and they prove it 100 times over many, many centuries. They just keep doing it over and over again. Here's a country, see what happened to Argentina. Why was Argentina so wealthy at the beginning of the 20th century, and now it's a disaster? And he talked about what's the key. Is it because of their infrastructure? Is it because of where they are relative to a waterway? Is it their culture? All these kind of things. And they go through it, and they have a model that says these are the countries that will do well. They have to have these things. So it's interesting. And then a student of mine sent me this link to this online course. And as I went through it, I said, that sure sounds a lot like Why Nations Fell. And sure enough, essentially what he did was a course based on that book. So if you don't want to read the book, you can take the course, and they walk through the same model. Very, very interesting stuff. You as an investor, that's really key. Why does one country fail when another one succeeds? If you can figure out what those things are, that can be really important. We know in South America right now, you got Peru going through some major problems. Chile's going through some things. Argentina, obviously, they're about to elect. Have y'all seen the guy they're about to elect? Maybe a pretty interesting guy. Obviously, Brazil just went through a major election. Where Colombia had a major election. Obviously, Venezuela or whatever. Every country it's a major, major shift going on in South America. Africa is going through quite a bit of turmoil, especially up north. So if you're doing international, there's a lot of things you got to look at. These writers give you really great insights on how to tackle these, what to look at. This guy, Sharma, he runs, I think their internet. I think he's head of their international. Very, very interesting. I heard a podcast. I can't remember which. It's one of those podcasts on my reading list. He was interviewed, and he was talking about his book. So I went out and got his book. He talks about the 4 Ds. Really, really interesting. Do I show the podcast up there? Yeah, there it is. Barry Whitholtz. So Barry Whitholtz, but it's back in 2016, so it's pretty old. But I did go and get his book. But he talked about the 4 Ds that he thinks is driving the world right now. So he's arguing Germany's not the place to be. Well, why is that? So why does he go through the 4 Ds? So the 4 Ds, he talks about depopulation. Birth rates are way, way, way down. Have y'all? He did escape. U.S. birth rate. Where are we now? Oh, that's not the right number. Why does that 12? Yeah, I don't know why they're showing birth rate by country. I guess we'll do. I don't know what that 12 is. Can you imagine the average woman having 12 kids? That seems a little high to me. All right, so that's per 1,000. So divide by, 5, 10. So the world is definitely, birth rates are dropping quite dramatically. Most of them are below replacement rate. So what's replacement rate? It's not 2. You might think it's 2, right? 2 people have 2 kids, so when they die, their 2 kids replacement. It's got to be more than 2 because some kids are not going to make it to adulthood. So maybe it's 2.2, 2.25, or whatever. So it can't be 2, but for most countries, it's well below 2. So
Yeah, I was gonna say, like, here in the U.S. specifically, these last few years, the only reason our population has grown is because of immigration.
yeah, immigration is important too. So you need countries that are well above their birth rates. So China's struggling with very low birth rates. Japan, extremely low birth rates. Most of Europe, very, very low. I mean, a lot of the world is just dying. There's a really, really good TED Talk. It's pretty old. See if I can find this guy. He's the guy with the buckets. Yeah, you'll see.
I know the marble guy.
No, he wasn't this one, it was the
Oh.
buckets. So, really good TED Talk. It's a few years old, but he argues why world population is going to hit 10 billion and just stop, and then decline somewhat over after that. Last night, was it Wayland that did last night with the world population, China peaking and coming back down? So these are important concepts because you need consumers, you need workers, you know, which countries. So you're trying to figure out what country to be in. You're going to see how are they handling birth rates, immigration, education, productivity. So those are the kind of things, if you're an international investor, those are the kind of things you want to watch. So depopulation is one. A second one is deglobalization, which is global trade. We're becoming somewhat negative on it. China and US having these big fights. You're seeing a lot of battles. A country like Germany that is so dependent on exports, he's arguing they're going to be in a lot of trouble in the years ahead. That's going to be a huge, huge struggle for them. Obviously, Russia has created some issues. Deleveraging, boy, there's so much debt in this world. What happens when you have a lot of debt and you have to start paying down the debt, where your growth rate is going to be restrained because instead of investing and growing and buying, you're instead paying off debt. So that's kind of the low velocity. And de-democratization, which there's been surveys in South America where a lot of people in South America have just said, we don't believe in democracy anymore. That's kind of scary. Why? Because the people they've been electing have been doing such a great job, in their opinion. That's pretty scary when the world says, we don't believe in democracy. Well, what do you believe in? A lot of them are saying, we just want a really good dictator. So that's not a good future world. But so he talks about those, and he also, in his book, gives you some ideas of what does that mean as far as an investor. Where can you put your money that things are going to be better versus worse? Worse. He actually says the U.S. is set up pretty well. Good immigration, really good research and development. A decent birth rate versus the rest of the world. Our population is not shrinking nearly as badly as China and Japan. India, obviously, India is going to overtake China here pretty soon. Really good educational system. You know, there's a lot going on with India, and they're doing really well this year. Those are the kind of things you're thinking about as an investor, and he does a good job of helping you do that. I don't know if he has anything more recent as far as books go. All right, so any questions on non-U.S.? That one's pretty radical. If I were you, and I wasn't so horrible at languages, I would probably be thinking about moving to another country and learning that country extremely well, because that would give you a huge advantage. You had to kind of risk it. We were talking about Africa for quite a while a few years ago, being the next big frontier for investing in Africa. I'd probably move to Botswana. But I don't know, Botswana's been pretty stable over the years. But is that going to be a great place to invest in the future? You know, I could go there and 20 years later, it still hasn't turned the corner. But what does Africa have that the world desperately needs? Everything an EV needs is what Africa has. So, you know, you got cobalt and whatever these other things are, all these precious earth things. But a lot of countries with not good institutions or leadership, but the value's there. So there's something there. Someone will finally figure it out, and boy, that's going to be the place to invest. But you'll take some risk on the way. Yep.
All I would say in terms of Africa, Nigeria is a country.
Yeah, that's why I say you almost have to move there and live there a few years, because you understand these countries from the inside out, especially emerging countries. But are you willing to move there? Is Nigeria a place you can speak English?
Yeah, that's their one of their primary languages.
Yeah, that's why Botswana is. You can go and get around with English pretty well. So, you know, it's almost worth the risk, because if you learn something that well, you have a huge advantage when you come back to the States as an investor. All right, so we're getting to alternatives. What are alternatives? Well, the intro to alternatives is pretty simple. There's only two things. We buy alternatives first and foremost for diversification. They tend to be uncorrelated with everything else. Secondly, alternatives include real assets, which tend to protect you from inflation. So those are the two main reasons you hear people talk about alternatives. Good diversification and good protection against inflation. But we're talking about real assets for that. We don't talk about private equity or hedge funds being a protection from inflation. We're talking about real estate, commodities, those type of things. So low correlation to other asset classes. So the subcategories we're going to do are real assets and private equity. That's all we're going to do. And in real assets, there's a lot of things on the real assets, but real estate, commodities, real estate, timber, commodities, and then everything else. There's a lot of other things too. So you can, I mean, a good example is infrastructure. Have y'all heard of infrastructure as an investment? What is infrastructure? Huh?
Like toll roads or something?
Toll roads, yeah. Can y'all think of that? See how I start typing something and it's right there. The category investments that involves financing, owning, operating physical assets to provide essential services. Usually they're assets that the government owns, but they sold off, like a toll road or an airport or a hospital or something like that, and you operate it. It's obviously got a lot of political risk because they could take it back at any time. But that is an asset class. It's a really popular asset class. Why? Because it's so different from everything else. We're not going to talk about infrastructure, but there's a lot of other things out there that fall into this category. So let's start with real assets, and we'll start with real estate. So a real asset is an asset you can pick up, you can touch, not like a stock. You know, a stock is a legal interest, but real estate is an actual asset. So real estate is buildings. Now, I used to say when we talk about real estate, we're only talking about commercial real estate. If you're talking residential real estate, that's a completely different thing because the institutional side doesn't do residential, but that's been killed because BlackRock has been buying a lot of houses. So the institutional side has started buying houses in a big, big way, but we're going to mainly focus in on commercial real estate. So when I was at USAA, this was a big issue for us because USAA had a $3-4 billion real estate portfolio, which is very, very unusual for an insurance company like USAA. We were way out of bounds versus everybody else. There was a few companies that may have 1-2% in real estate, and we had 10, 15, 20% in real estate. It was a huge investment. So I was sitting at my desk as a security analyst, and I got a phone call and said, "Ron, we want you to work in this new department. You can say no, but if you do, you make a big mistake." So I didn't really have much choice. And that department was a small department. And the biggest issue they want us to address is, should USAA be invested in real estate? And that was pretty interesting. My boss was like, no. The guy from real estate was saying yes. And so I was kind of caught in between. And so we had to figure out, how do we address real estate as an asset class? And it's really, really tough. It's hard to get good data. Real estate doesn't trade every day, so you don't know what the market value is. It's based on the appraised values, which are completely unreliable. So you really don't know the value of real estate. So knowing what the true return on real estate is really, really tough. So you have what they call appraisal smoothing, because the real estate's not trading every day. You don't know the true market value, so you're just kind of guessing. And because you're using appraisals, real estate, when you look at indices, doesn't look very volatile. It looks very, very, very tame. But that's artificial. If it was traded every day, it would look just as volatile as a lot of other things. And so you have that issue getting expected return, especially getting risk and correlation is really, really tough to do. Real estate, you don't have good data. The databases that are out there are typically quarterly databases, not monthly or daily like you can get for stock and bond markets. But quarterly data, that shrinks your sample size by quite a bit. So you don't have as much historical data, and it's unreliable data. Most firms, when they do appraisals, they do most of them in the fourth quarter. So the fourth quarter is real noisy, and the other 3 quarters are real smooth because they just make small tweaks, like change the interest rate or whatever. So it's a really tough asset class to know your true return. It's also an extremely illiquid asset class. So you can't just trade it real quickly. It can take months to sell it. So you have a lot of uncertainty. If you look at the research we did in that year we spent looking at real estate, and we looked at other things as well, that was the same group I was in when we got rid of all the mortgage-backed securities. So when you look at it, we had a thick report on real estate. We tried all different ways to try to figure out what real estate was. I had a lot of pressure to say, get rid of real estate. I was like a tiebreaker, the realtor guy and the stock guy. I was in between. I came from investment firms, so they were assuming I was going to be on the side of get rid of real estate because the investment firm wanted all that money. And I came down on the side of real estate. And so the real estate people loved me a lot after that. It was kind of great. I had this great cozy relationship with them. Not that they bribed me or anything. I was just my opinion. I thought real estate made sense. And it ended up being the right decision. USA's real estate did exceptionally well after that because Ed Kelly and Pat Duncan, they had some people come in that really knew what they're doing, really cleaned up that real estate portfolio, and it just did exceptionally well. So we're fortunate we stuck with it, but we had a tough time just coming up with assumptions. So we generally came up that real estate has a risk somewhere between stocks and bonds. It's not as risky as stocks, but it's not as safe as bonds. And then the correlation, we kind of, you should see all the things we tried. It was pretty interesting trying to come up with this. We read so many articles, and one thing I learned that I highly recommend. I remember we read an article there's two people we read. We thought this was really interesting, so we just called them. And one guy, Dan Cashin, he wrote an article, and he was like shocked someone called him. He was like so excited someone read his paper. He was like, "No, it's really, really good." So I did that a lot in my career. It's amazing. You just call people and they'll talk to you. My opinion is I was really shy. So you're thinking I could never do that, but I should have never done that. But I did it all the time. And what's the worst thing they can do to you? They can't torture you. They can't shoot you. They can't do anything. I mean, they can hang up on you. And they're not going to remember you 3 months later anyways. So it's like, to me, and you know, I had one economist that was irritated with me, but he answered all my questions. He was like, you could tell, he's like, you know, you can tell he's wanting to hang up. Other than that, everybody I called, I remember this guy, one thing, Brian Rom, he wrote an article in the Financial Analyst Journal. He was selling something, so he was excited for me to call, but he talked to me forever and ever and ever, hoping I'd buy his product. We never bought his product, but you know, it was great. So you can get a lot of free consulting by doing that. But that's what we did. I read a lot of articles on how do we express what real estate is, and it's not easy to do. And a USA is commercial real estate. Commercial real estate is broken down geographically and by property type. So geographically, there's the main regions in the US, South, Midwest, North, Northeast. And then property type, things like hotel, office, which obviously office right now is really, really struggling. We talked about that last night in the investment society. Retail, obviously, is struggling as well. You got a lot more kind of work delivery to home. Industrial is doing pretty well. Apartments, I'm not so sure about. Malls. Has anyone here never been in a mall in this room? Anybody? So y'all all been at least once. Which mall do you go to? Y'all go to North Star? Yeah, we used to do. That was like the thing when we were kids. I just assume the only one in malls now are people over 70 that are just walking in the air conditioning. So malls are really, really struggling, but La Cantera is doing pretty well. That was one of USA's investments. That's doing well. So all these go through different cycles. Geography can also mean non-US. There are non-US real estate portfolios that you can do. NCREIF is a really good website. Although they used to have a lot of free stuff, and now they require you to register. Of course, it doesn't work. So institutional real estate, so NCREIF, they used to have data that you could get for free. And I used to use it all the time. And the data they provided was quarterly returns for real estate back many, many, many years. We use that data. So now you see they have a firewall, you can't get in. That probably costs you a few $1,000s just to get in there. Let's see, I'll try it. Yeah, they're not letting you dump. You have to log in first. So they say this last quarter, real estate was down 2%. That makes sense because interest rates are up. Obviously, real estate's very sensitive to interest rates because it's just a discounted cash flow. You can see the different kind of groups that they have. So which of these is the best? USA's big thing. USA had a lot of hotel because of La Cantera and then Four Seasons. That was kind of their biggest asset class. Not so much that that's what they wanted, but that's kind of what they inherited. We also had a place called Six Flags Fiesta, Texas. It wasn't called Six Flags back then because Six Flags bought it from USA. How good of an investment is that? Y'all want theme parks? What do theme parks do in November, December, January? They sit there empty. That's not very good. Very capital intensive. So what we noticed with, I'm telling you inside stories here, but when Fiesta Texas opened up, USA said, let's test it with USA employees. And so we went, we all got in free. We thought this was cool. It was miserable. It was so crowded. Just any ride took hours and hours. Thought, wow, this is really miserable. And we get back and the real estate people are saying that crowd you saw, we need to average that every day to make money. I was thinking you might average that on Saturday, but you're not gonna get that Monday through Friday. I was like, there's no way this place is gonna make money. It was just terrible. So USA sold it to Six Flags. It's the only sell I know. When you sell something to someone, you have to write them a check, but that's the kind of investment USA had. Not a good investment, but that wasn't the group they had. You know, the Ed Kelly and Pat Duncan, that group knew what they're doing. That was kind of pre them. So, you know, I don't even have that in, but industrial is the thing USA was really, really good at doing. Build-to-suits, buildings, big manufacturing and storage places for Amazon and those kind of places. Those things have been doing well because of e-commerce. There's a lot of buildings just sitting there, cheap to build. They were needed. They pay, you know, they pay up pretty well for them. It's been a good investment. So can we get around this by using publicly traded real estate investment trusts or REITs? And that sounds like something really liquid, right? You can buy a stock that invests in nothing but real estate. That sounds good. The problem is REITs don't look like real estate at all. They look like small cap stocks. And they trade like their volatility, their returns, their correlations, everything looks like small cap stocks. So if you buy REITs, you're really buying small company stocks that just happen to be exposed to real estate. So you really can't handle that. There is a good website, REIT.com, that you can look at. NAREIT's another one, NAREIT. But it's a small part of the real estate market. I mean, remember I showed you last class, it's only like 2.5% of the S&P 500. That's a very small part of the stock market. The REITs are driven by the tax code. So the tax code says to be a REIT, you have to have a certain percentage in real estate. And why the tax code is important because REITs are tax-free, which is kind of cool, right? They don't have to pay income tax. The investor has to pay the tax because the IRS requires REITs to distribute a lot of their income. And so their investors have to pay a lot of tax, but the REIT itself is tax-free. So that's kind of cool. So that doesn't really help you. One of the things we tried at USA was we took REIT indexes and we try to hedge out the small cap piece of it to see if we could end up with a real estate return. But I mean, it was interesting. We ran an article, we tried everything we saw, and there's just no way to kind of take out, you know, buy REITs, but short small cap to see what you're left with is real estate. It really doesn't do that. Obviously, over long term, REITs are going to be like real estate. They're going to run like that market. But on a month-to-month, even year-to-year basis, there can be some pretty big differences between them. So we're not considering residential real estate, but it is becoming a big asset class out there. I don't know how much residential BlackRock owns, but it's pretty massive what they're doing. A lot of that's because the U.S. housing market was so strong there for a while. I don't know if we have real estate majors in here. That's kind of a specialization. It's a very different world. I always thought, because I work closely with the real estate company and the investment company, it's like two different worlds. The way they talk, to kind of just how they interact with each other, very, very different people. I won't tell you my opinion on, just in case we have real estate majors. I did like the real estate people better, but for very, very different groups of people, it just seems like two different, very different worlds. All right. So we have timber. What is timber? Trees, wood. Timber as an asset class. It's a really, really great one. It's one of my favorite. Timber used to be on GMO's list. They used to be big believers in timber. I don't know why they took it off the list. But timber's the wonderful thing about timber is that it is both a real estate it's real estate, but it's also a commodity. It's kind of both. So it's land, it's real estate, but it's real estate with a commodity of lumber on it. Yeah, I've seen some of those, and how many stories, I forget, the tallest building is pretty tall now. Yeah, it's wood's finding other applications. So timber can be used really three ways. I got two up there. You got paper, and then you got construction, and it's hard and softwood, but you also just have the real estate itself. So it's the wonderful thing. Real estate is, you know, if you don't like the lumber, you can sell the real estate, and that's an investment as well. Which areas of the U.S. are lumber? What states do you think of?
The Northeast.
Northeast, Northwest. What state don't you think of that's a major lumber? What state do you live in that is a major lumber producer that you don't think of as a lumber producer? Texas is a major producer of trees. Now, if you don't ever go to East Texas, you don't know that. But East Texas is a gorgeous area, isn't it? It's massive trees, really, really beautiful trees. Yeah, Texas is a major producer of lumber. In fact, there was a hurricane that came through and knocked out a lot of those trees. It was really pretty devastating. Really, really was serious harm to the lumber industry. So timber has provided really good returns. It's also a great diversifier because it's hard for us to ship trees to China. It's hard for Europe to ship trees to US because they're just so heavy. It's hard to put a bunch of trees on a boat. They do that. And where I'm in Costa Rica, it's so bizarre. We're in the middle of the jungle. And suddenly a few years ago, I show up and there's all these pine trees. I'm thinking pine trees in Costa Rica. But they discovered pine trees, you know, y'all know Bastrop in East Texas, those pine trees. That's what Costa Rica looked like in that area. But they discovered pine trees grow really well in Costa Rica. And they started the farm many years ago, and now they're all maturing. In fact, the last time I was there, there's a big trucks taking trees out. Where they're shipping them to, I don't know. They're probably keeping them, most of them in Costa Rica because it's really hard to go other places. So, you know, there's more and more places discovering the use of timber and trees grow well. So it gives you a diversification that you can't get with other things. It is, people say, well, isn't it highly tied to U.S. housing market? It is, but not as much as you would think. Some people worry about insects and disease and hurricanes. That's part of it, but it's not a major part of the return. Over time, it's not that huge. I know in East Texas, they're having trouble with some disease that was attacking the trees. And for some reason, the pine trees in Bastrop weren't getting attacked, and they were trying to figure out, you know, so there's a lot of science behind this. People do research what trees are more resistant to certain things. So it's an interesting world. And one thing people love about trees that's very, very unique, if you don't like the price of timber, you can just let the tree sit there. And what's the tree doing while it's sitting there? It's growing. You can't do that with oil. You don't like the price of oil. If you sit it in a barrel, how much more oil will you have a month from now? It's the exact same amount of oil. Right, cattle, you can do that a little bit. We do a lot of cattle loans, but there comes a point where the cows just can't get much bigger. But the tree will keep growing, keep growing, keep growing. So that's what they call store it on the stump. It allows you to just sit there and wait it out if you don't like the market, and you'll have more product at the end. This website is a good one, HTRG. It's a firm that got bought out by somebody else, so that's why they're changed. And what color is it going to be? They cut down trees, they dig them up. What color? What do they want you to see? Green. Everything on here is green. Why don't they show an empty field with all the trees dug up? Because they're very sensitive about that. They say they're good for the ecology because they plant all these trees and they control it and they make sure, so they talk about it. I don't know if y'all have seen how they cut down trees these days. It's not the saw anymore. Have y'all seen these machines that just grab it and rip it out of the ground? It's pretty amazing. So timberland investment, this used to be Hancock, and then they got, I guess they merged or something. Creating value through sustainable, they even got sustainable right there, management of timberland assets. What sets us apart, sustainable, they even have sustainability. So obviously they're very, very sensitive about global climate change and those kind of things. That's a big part of what you're doing. Now, if you're looking for a career, you haven't decided yet, this is a career. So what would you do? I'd be almost tempted to do this. So I would probably get my undergraduate in finance. I'd probably go to A&M, get a forestry degree, and this be the rest of my career. We talked to a timber guy at UTSA. He was in a suit. This is back when we wore suits. And he said, yeah, I usually don't wear suits. I'm usually in blue jeans and a t-shirt. Everybody in my department said, I'm a timber guy. Pretty cool job. You can specialize in it. It's finance plus forestry. If you do that, this is your career and you're set for life. This is probably an industry that's going to be around for quite some time. I can't imagine we're going to replace it with some synthetic tree or something. So you could, I don't know if Texas A&M has a forestry degree. I just assume they do. I don't know if UTSA has one. So you wouldn't want to get a finance and then a master's in finance to do this. You'd want to get that whole area. Yeah, you could make a lot of money. It pays as well as anything else in finance. And you'd be out looking at trees and visiting sites all day long. It seems to me like a pretty cool career. Here's their portfolio. So US South, there's Texas. See that? 29%, almost a third of their portfolio is coming from the area. You go up north and say you're from Texas and they visualize this desert and cowboys and windmills. They don't realize how beautiful East Texas is with all the trees. The Pacific Northwest is pretty big. New Zealand is a big timber place as well, but unfortunately it's way out there in the middle of nowhere. So you got a pretty heavy shipping costs. Australia, US Northeast, US. Now this is their portfolio. Obviously Canada's a huge timber. They're just not big into Canada. It's interesting. 20% is New Zealand though. Softwood, hardwood, mixed. There's their team. I don't know if the guy we met with is in their team. I don't know if I'd recognize him. It's been so long. Everything's green though. You notice it? Whoever designed their site is like making it look as like a vacation out in the country as you can. But they do a lot of planning. So this is what Costa Rica looked like, just brand new trees. And over time, it takes like 20 years for them to grow up. So it's probably been about that. See, I went to Costa Rica in 2007 and they weren't there. So they're starting to get some growth now. They can cut the trees down. So 10 years, maybe they get trees that you can handle. So it's an important part.
So you think they own their land, or you think they just operate mostly on
They
leases?
they probably own their land, but I don't know for sure. Yeah, I would think so. There's one paper company, the American Paper Company or something. They sold a lot of their timber, became just a paper company, and they were selling their land. It was a big part of their portfolio they got rid of. So I don't know if I convinced any of y'all about a career change, but it would be pretty cool. I think you get these unique advantages if you specialize finance plus forestry, and there's not much else you can do, but also when you show up for the job, you essentially got it. They're gonna hire you because that's what they're looking for. So it's pretty simple. Right. Yeah, I love timber, great asset class. Oh wait, commodities. A lot of commodities. We usually break them into energy, agriculture, and metals. They tend to have some protection from inflation, but also commodities tend to have super cycles. So when the whole world's going up and down, commodities tend to have these 10, 15-year cycles. We see oil going up for a while, coming down for a while. That kind of overload over the overall economy and what's going on. FinViz does a good job of identifying these. I showed y'all FinViz before. So if you just click on futures, wow, everything's red today. So the VIX, what is the VIX? Volatility index. You could put that into your paper one if you want to. The VIX is up a bunch today. Heating oil is up a bunch today. And the S&P is not the lowest thing down here. It's hogs are down today, oats are down today, natural gas is down today. How can heating oil be up and natural gas be down? That's kind of interesting. But everything's down. This is just a really, really red. I don't know if I've ever seen it that red before. We only have really two that are up. But those are the different ones. So here's the stock. Those aren't commodities. Currencies, stocks, VIX. Here's the energy, WTI, Brent, gasoline, heating oil, natural gas, ethanol. Here's bonds. Those aren't commodities. Then you get into the agriculture, cocoa, cotton, orange juice, coffee. Coffee is the thing we sell in Costa Rica. There's lumber. Let's see how lumber is done. So when you do this, you can do monthly. Oh, they didn't let me do monthly for some reason. Yeah, they've changed their site. But you can look historically, or you used to be able to look historically at how the asset class is doing. Sugar, I don't think of lumber as part of agriculture. To me, lumber is a complete different asset class. Then you get into the metals, gold, silver. Gold and silver are interesting. Gold is a precious metal, so we don't usually use gold for production. It's just in jewelry or whatever, just sitting in bars and locked away somewhere. Silver is a precious metal, but it's also production metals. So it's going to be more sensitive to the economy than gold will be. So some metals are both production and precious. Some are just really just like copper. Copper is essentially a production metal, especially these days. You would think copper prices would be up a bunch because there's so much of that going into electronic vehicles. Palladium, more agriculture, cattle, feeder cattle, lean hogs, soybean, a lot of agriculture, wheat, rough rice, oats, canola. And currencies are not commodities, so you can ignore the currencies down at the bottom. Each one of those can be your entire career. You can spend your whole time as a trader. You go work for Valero, obviously you're going to be a trader on oil, gasoline. That's going to be your thing. You're going to know those markets, understand backwardization and contango and all those kind of things that drive futures markets. So can you buy these indices? There are now exchange traded funds that we'll talk about that are commodity funds. There's one called the S&P GSCI, and then there's the AIG. I've had trouble finding the second one in a ETF. They're very, very different. The S&P is like 60% energy. So if you buy it, it's going to go. It would have done great in 2022. And probably is off this year. It would have done horrible in 2020 because it's heavily dependent on energy. Whereas the Dow Jones or AIG is only 30% energy. So I would probably prefer the second one to be a little bit more diversified, but they're very, very different indices. So how you weight these, there's no real obvious way to know what percentage you energy. It's kind of tough to make those decisions. So they're there. I gave you some websites, but I'm not sure exactly what the websites are gonna. Yeah, I'm not gonna be able to get into that website. So you might check them out. Or you could do the individuals. There's probably oil ETFs and gold ETFs and those kind of things that you can just buy the individual pieces. I don't know how far down you can go. I don't know if there's like a lean hog ETF. There probably is. Exchange traded funds have gotten out there they're pretty covering everything. Most likely you'll pick one of these major indices and just use that as your investment. What I've wanted to do, I haven't gotten around to it, is to test these in inflationary environments and see how they do, because gold did so horribly in 2022. As our inflation hedge, it didn't really help us because the dollar was so strong. That might be true for some of these others. Now we know oil did well last year. So is oil the better inflation hedge than gold? And that's something I wanted to test. I did a correlation between gold and inflation and gold and the US dollar. And gold is much more heavily correlated to the dollar than it is to inflation. So gold is more of a dollar hedge than it is an inflation hedge. I think oil might be the better inflation hedge, but that's what you want to kind of test it. So you might actually want the S&P because you really want, usually if inflation's up, energy prices are up pretty consistently, no matter what the dollar is doing. So it's a little bit safer bet, maybe, but I don't know. I haven't had time to test it. All right. So should that be in your portfolio? Most people know if we went back to Vanguard, you have a tough time finding commodities as an asset class. It's kind of tough. At USAA, we had a gold fund, but it wasn't a gold fund. It was a fund that bought companies that produce gold. It was a gold stock company fund. It was actually down in 2008 when the stock market was up. Why? Because, when the stock market was down and gold was up. So in 2008, our gold fund had a negative return, even though gold prices were up. Why? Because we were buying gold companies, not buying gold itself. It's a tough asset to buy. Gold itself is pretty tough. You're not going to actually buy bars of gold and stick them under your bed, probably. So it's a little more challenging asset class. You do have futures. The futures market does give you a lot of liquidity, so you can trade in these. We'll talk about futures later, so that gives you a little bit more ability to invest. But you have to decide if this belongs in your portfolio. One mutual fund I inherited when I went over to equities, fortunately they had fixed it before I got it because it was a disaster in the few years before I had it. But it was 25% stocks, 25% bonds, 25% real REITs, real estate investment trusts, and 25% gold stocks. Ridiculous allocation. Oh my word, it was terrible. It blew up on them so horribly. The REITs, they said, well, you need 25% real estate. Well, that wasn't 25% in real estate. That was 25% in one small segment of the small cap stock index. So it was just flying all over the place. And 25% in gold, nobody does. In fact, the guy that worked for me, he ran the gold fund. He never recommended more than 10, and we had 25%. So fortunately, I inherited that fund, but well after its disaster years, it was just not a good investment. Just way too volatile. And you think 25% in gold, where gold just didn't do anything for 2 decades when the stock market was shooting up, that mutual fund just looked horrible. So it's tough. If I were you, I would, if you're worried about inflation, I would definitely have 5-10% in commodities. And then you got to figure out how you're going to execute it. It's going to be tough decisions. Questions on commodities? Any of y'all commodity traders? Now you can be a commodity trader and not know anything about your commodity. I remember I was talking to an oil trader, and I go, "What do you think about oil prices?" He says, "Oh, I don't really think about that." I said, "Well," I said, "No, I'm a futures trader. I'm managing backwardization and contango. That's all I care about. I'm the mechanics of the market. That's what I manage. I don't have any opinion on oil prices." I said, "Okay, that's interesting." The guy who worked in my department, I had the gold fund under me. My job was to stay out of his way because he's really good. So it's like, "Do whatever you want to do." He says, "Ron, I got to fly to South Africa to visit mine." He says, "Yeah, whatever you want to do, go have fun." But he was responsible for giving us insights on gold. And he had a list of things he looked at. One was obviously the US dollar. One was the US stock market. The US stock market's doing well. Gold usually doesn't do well. Thing about inflation. He also had supply and demand because there's been, South Africa is going through kind of a, South Africa is a major producer of gold, and their mines have been having a lot of strikes and being shut down. So the supply side is having some issues. So he had a list of things, and he just looked at each one of them. And what was the overall story? Is it positive or negative for gold? And that's the approach that he took. So, you can do some little specialization in here. All right, and then other real assets, we're not going to talk about it all, mainly because I don't know anything about them. But artwork, collectibles, I don't know, Bitcoins fall in there, but very, very, very specialized market, very illiquid market. There's an index that I think I can't remember what this goes up to, 2021 or whatever. It's a few years, but it shows you what some of these are. So art, there's several art, fine wine. I don't drink, so I don't know what fine wine is. I do know studies have shown that the best wine tasters in the world can't tell the difference between good wine and bad wine when you test them, and it's like complete randomness. That may be true with artwork as well. Stamps, coins. There was a student in this class who was a coin collector. I see him on Facebook. He gets all excited about finding a coin. That's possible. Classic cars. I don't know anything about that. Rugs and carpets, musical instruments, jewelry, watches, prime properties. And then their index, it's up 90% since 05, but I don't know what year it goes through. I found this twice, and it was the exact same chart twice, and it was 3 years later, so they haven't updated this in a while. 90% sounds like a good return, but it's not annualized. So if that's over 20 years, that's like 4.5% a year or 4% a year. So I don't know what period it is. So it's more, and there's others. So talk about Costa Rica. I found a guy in Costa Rica. Guess what his asset class was? What would you produce in Costa Rica that would be a collectible? So he did beetles. He went out and he knew what he's doing. He went out and he produced beetles that didn't exist before. He got 2 beetles and had to somehow get them to like each other. And they produced another beetle, and he was selling those things for $500 to $1,000. He gave us some of his cheaper ones, and we took them back. I don't know how he got them from customs, but his wife was the butterfly person, but she was doing this artwork. She had it's really cool. She had like this hot green room. You walk into it, there's just butterflies everywhere. It's so cool. You walk in there, flying all around your head. Really, really cool. But she did artwork, but her husband did beetles, and he was selling them quite handily. It's really, really impressive. All right. So if you're going to do those, you better have some expertise, because that's a world into itself. All right. I'll do venture capital next time. And then next class, we're definitely going to be getting into that question 2 of exam 1. So you're getting exam 1, question 1 done, right? Y'all been typing that up, getting it in your own words. So we'll start working on question 2. All right. I'll stop a little early.